Hi, Brendan here with another episode of Coach Key TV. Just got back from Cincinnati, attended the AAC, it's the Abundance Advisors Conference. Go every year because invariably after 20 years of going out there, I still learn something that just makes it all worthwhile. And I thought I would share with you something that I learned out there. I had a conversation with a representative of DFA, that's Dimensional Fund Advisors, and they're the sub-advisor for the Matrix portfolio, so I thought I would share something with you. We're going to call our presentation here called Understanding Active versus Passive Investing. And it's a pretty difficult thing to understand, so I thought I would try to explain to you a little bit here. Active versus passive. There are activities with regards to active money management, stock picking, market timing, track records. These are the components that go into active money management. And what they really are, they're speculative activities. What you're trying to do is figure out what's going to happen in the future such that you could either be in the right stock or be in the right market or get out of the wrong market, etc. before it goes down. So that's active management. The other side of this is passive money management. The components of passive money management are this, is you want to own a cross-section of markets, both stocks and fixed, which are bonds. You want to diversify, you want to buy low, sell high. These are not activities that employ in any way, shape, or sense any speculation whatsoever. There's no speculation involved in this. But here's the thing, most people, I think, when they get the impression passive, they think once these things are done, there's nothing else done to the portfolio, like you kind of walk away from it and it regulates itself. And in the conversation I had with a representative of DFA, that is not in fact the case. And I thought I would show you a real life example of how they intentionally make sure the integrity of this portfolio is correct at all times. Real life example, and he shared this with me. A couple weeks back, Goldman Sachs was charged by the SEC. Hi, Brendan here with another episode of Coach Key TV. Just got back from Cincinnati, attended the AAC, the Abundance Advisors Conference. Go every year because invariably after 20 years of going out there, I still learn something that just makes it all worthwhile. And I thought I would share with you something that I learned out there. I had a conversation with a representative of DFA, Dimensional Fund Advisors, and they're the sub-advisor for the Matrix portfolio, so I thought I would share something with you. There's 12,000 holdings in this company. Presentation here. This is an activity whereby active versus passive investing. Actively and making sure difficult thing to understand. So I thought I would try to explain to you a little bit here. And again, so I thought I would share that versus passive. That's a real life activities with regards to active money management. There's a lot of other things that go into making sure the integrity of this portfolio. These are the components that go into active money management. Exclusions to what they really are. They're speculative activities, which are trying to have any companies in what's going to happen in the future that are bankrupt, you could either be in the right stock or be in the right market. There goes your Goldman Sachs situation, etc. Before it goes down. Partnerships, that's active management. No closed. The other side of this is passive money management. No real estate investment trusts. Components of passive money management companies that are undergoing a cross-section of markets, merger, both stocks and fixed, which are bonds, or bring into the portfolio any limited buy low, sell high, limited partnerships. These are not activities that have limited operating history. In any way, shape, or sense. There's a few more of these, speculation whatsoever. There's no speculation involved. When they're engaged in this passive money management, most people, I think, when they get the impression they are passive day and night to make sure done. There's nothing else done to the portfolio. Stays whole, and just kind of walk away from it and regulates itself. So again, I thought I would just share that. And in the conversation I had with the representative of money management, that is not passive money management. I thought I would show you a real life example. Is no speculation. If I'm a passive money manager, make sure I'm not engaged in any speculation whatsoever. If I'm engaged in active money management, real life example, all the time I'm speculating, I'm trying to figure out what's going to happen next. Goldman Sachs was charged by the SEC. No speculation whatsoever, failing to reveal a conflict of interest. Here's one of the things that DFA did, is they took Goldman Sachs off of their buy list. When the news broke, they weren't going to buy any more of Goldman Sachs stock. What they didn't do, and what would have been speculative had they done it, DFA didn't sell the Goldman stock that they already had, even though it makes up less than 1/2 of 1% of the total portfolio. There's 12,000 holdings in this company. Again, This is an activity whereby, again, they're actively making sure the integrity of the portfolio is kept whole. And again, so I thought I would share that with you. Again, that's a real life example. There's a lot of other things that go into making sure the integrity of this portfolio is whole at all times. There's exclusions to what DFA will do. For example, they won't have any companies in their portfolios that are bankrupt or are under extreme distress. There goes your Goldman Sachs situation. No limited partnerships, no closed-end investment companies, no real estate investment trusts. They won't buy companies that are undergoing or the target of a merger. They also won't buy or bring into the portfolio any limited partnerships, or that companies have a limited operating history. So again, there's a few more of these, but again, DFA, when they're engaged in this passive money management, they're not just doing nothing. They are working day and night to make sure that the integrity of this portfolio stays whole and is true to what they're trying to do. So again, I thought I would just share that with you. Active money management versus passive money management. The key component is no speculation. If I'm a passive money manager, I'm not engaged in any speculation whatsoever. If I'm engaged in active money management, all the time I'm speculating, I'm trying to figure out what's going to happen next. Again, passive, no speculation whatsoever. It's to the benefit of the investor. Thank you.